Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Good evening, everyone watching Kwani Good Night. I'm securities analyst Shi Young Chung. It's been a long time, almost a whole year since we last met. Just this afternoon, while I was preparing my presentation, I suddenly realized that the last time I got ready for a Kwani Good Night briefing was on February 14th last year. It's really been a while, almost exactly a year. I wonder how everyone has been doing over the past year. I hope that some of the advice we gave back then has been helpful to you, and I also hope that over the past year, everyone's wealth has grown. I hope that everyone's health, careers, and families have all seen even more fulfilling and better development. And since the Lunar New Year is coming up next week, I just want to say, last year at the start of the Year of the Rabbit, I was here with all of you, and now, well, as we approach the end of the Year of the Rabbit this week, I've once again come together with all of you. I hope that as we enter the Year of the Horse next week, everything will go smoothly for everyone, and that wealth and prosperity will come your way right away. So here, I'd like to wish everyone a Happy New Year in advance. Next, there are actually a few important pieces of news I want to discuss with everyone. For this segment of Good Night Me, the topic I've chosen this time is something I'll probably be focusing on quite a bit this week. In other words, over the coming week, I'll be talking more about related topics, sharing some discussions and thoughts, as well as offering some perspectives on individual stocks. So basically, for the next few weeks, we'll probably be sticking to today's main topic and expanding on it in more depth. I just wanted to give everyone a heads up that this is likely how things will develop, because it will have a significant impact. Well, maybe not significant, but it will definitely have a profound influence on the direction of asset allocation in 2026, as well as on how we should go about stock selection in 2026. Actually, before this, whether it was during my morning calls or at offline events, I think I've already talked about similar topics. I've discussed things like real assets, group production and related demand, as well as raw materials, and even the inflation theme might become a pretty important direction for development. So back then, I suggested this to everyone during the morning call, and now in the evening session, I'm sharing the same kind of content with you all again. In fact, for AI-related stocks that already surged from April to October last year, they really shouldn't be the core of your strategy this year. They shouldn't be your main focus this year. You should have already started reallocating part of your portfolio into other related traditional industries. Traditional industries, especially those tied to the economic cycle, should be part of your allocation. In particular, companies that hold production resources and possess real, tangible production value and productivity might become a more important direction to consider. And actually, in the past few weeks, especially in the Taiwan stock market, traditional industries have indeed responded accordingly. The same exact situation has also happened in the US stock market. Has anyone noticed this? All the AI concept stocks, except for Google, which is still hitting new highs, aren't really reaching new highs, right? No one else is. But there is one stock, a huge one, that is hitting new highs. And it's a classic example of a company that holds real production value and production resources. And this company is basically the most important core mainstream in the US stock market right now. So that's why the topic I listed here is about shifting from the virtual to the real, becoming the mainstream. I put a question mark here, kinda to keep it suspenseful, but in reality, it should already be considered a complete mainstream trend. Next, is the Dow Jones glory still online? Actually, my conclusion is simple. Shifting from the virtual to the real is definitely the mainstream, and the glory of the Dow Jones will absolutely remain. So this year, as long as you lean towards, when it comes to US stocks, if you prefer index trading, personally, I would recommend the Dow Jones this year. I would lean towards trading the Dow Jones. If you feel that the Dow Jones is too risky, then go with the S&P 500. I strongly advise against trading the NASDAQ index. I really don't recommend investing in the NASDAQ index. As for the Philadelphia Semiconductor Index, it's a bit special because it actually includes a lot of companies with manufacturing attributes. Its industrial attributes aren't actually that bad. So basically, the stronger the industrial attributes of an index, the better its performance tends to be this year. So that's a simple takeaway. Next, we'll talk about how the big win across the board yesterday will impact the overall market. What other latest topics were discussed? We'll be talking about all about with everyone as well. Alright, some important news before the market opens. Meta has been warned again in Europe. So basically, these AI stocks are constantly surrounded by all kinds of news, and there will be a lot of negative headlines coming up. When that happens, the media will be quick to tell you all about it. Why are AI stocks dropping? It's because of all these negative headlines, but at its core, let me just say it directly. The real reason is that AI is about to reach a turning point, and the biggest winner might actually be Google. In the end, it could be Google who comes out on top, even though others are still pouring in capital investments right now. But in the end, even if they manage to cash out or actually turn those investments into real profits, they might not be the true winners after all. This is something everyone should really pay close attention to and be cautious about. So, for example, Johnny himself has a very large position heavily invested in the Magnificent Seven and AI stocks. Personally, I strongly recommend reducing your positions. To be honest, talking about cutting back now is a bit late, since a lot of these stocks have already dropped quite a bit. But if Johnny had already made some adjustments earlier, or if you followed our morning call before, you probably already heard us say that AI-related positions might need to be trimmed. If you adjusted back then, now if you're thinking about increasing your positions, you definitely shouldn't be adding to anything related to AI. Instead, consider increasing your positions in stocks with industrial attributes or those more closely tied to the real economy. That could be a better direction for your investment strategy. And then another point raised by the so-called three-kill bandits is that even if Watch successfully gets nominated and becomes the Fed chair, it's unlikely that the balance sheet will be reduced. Actually, this ties into another rumor involving Watch and Basant, suggesting that there might be a new agreement or mechanism put in place to limit the Fed's actions. Actually, the last thing is this. When it comes to yield curve operations, if there is curve control, it's likely things will move in that direction. Once that happens, it basically means they'll be injecting even more liquidity into the market. But well, if you think about it, right now part of the market is seeing a valuation correction. But what's strange is, even with this correction, we haven't really seen a major crash. That's absolutely expected, because the whole economy and the entire system haven't really run into a serious problem yet. So it's more likely that we'll see a gradual shift from high valuation stocks to lower valuation, or even high value stocks. So this year, it's possible that the market will move in this direction. Plus, if you look at the past few years, 2024, 2025, there's actually been a pattern. Around January to February, you can really see which stocks are strong and which are weak. That will determine who will be strong and who will be strong for the whole year. I think I mentioned this to everyone in my 2025 year-end talk as well. Whoever is the strongest or weakest in the first month to 6 weeks of 2025 will basically set the tone for who will be strong or weak for the rest of the year. Last year's performance throughout the year completely proved this point. The stocks that were the strongest in the first 4 to 6 months were all AI hardware and AI software. So the strongest sector for the entire year last year was really AI hardware. Guarantee, and looking back, who was the strongest in 2024? Actually, it was the big tech giants who were the strongest. So the year before last and last year, well, in 2024, the big tech companies were all extremely strong throughout the year. All right, so what about this year? Let's really take a look together at which sector has been the strongest so far. Also, there are rumors coming out of China that they might guide their financial institutions to reduce their holdings of US Treasury bonds. So that's also a potential negative factor. The yield on US Treasury bonds might stay high. Oh, and then early this morning, there will be the New York Fed's inflation expectations. Just take a look at that, nothing major. Then there are speeches from Waller and Milan. Milan will definitely be talking about easing, large-scale easing and rate cuts, and saying that there will be rate cuts at every meeting in the future. Then Waller becomes more important, because whether he will change his stance, whether he will completely shift to a fully dovish position, could be the main thing to watch in the next few meetings. Alright, first, let's take a look at the Kaohsiung 4th District. Actually, in the 4th District, about 2/3 of the votes were won, and it was a decisive victory for the Kuomintang. Really, over in Japan, on 2channel, and on all kinds of local forums and online message boards, people were talking about it. The forums were absolutely flooded, with everyone mocking them as much as possible. It was really a crushing defeat. For example, it really was a terrible loss. Cao Si has really strong support among young people, and the reason young people support him so much is partly because he represents something pretty new. This new vibe is also something completely fresh for the LDP. So basically, if you look at the LDP now, you can see that several of their winning candidates are deliberately making statements aimed at appealing to young people. They've also been deliberately using rhetoric to win over the general electorate. So, in this political maneuver, I think the LDP has been quite successful. They've really managed to secure a very impressive victory. For the first time this past weekend, Saturday and Sunday, many places in Japan, like some of the country's top universities, and now in many areas, airports have been completely shut down. But actually, this didn't affect their ability to secure this crucial victory at all. So today, Japanese stocks surged and bonds also went up. The bond yields also rose. So why did this happen? Actually, the key point is that Koshi made a few important remarks earlier. He wants to inject liquidity. That is, he plans to cut taxes and implement some more relaxed fiscal policies. And his approach to monetary policy is leaning more toward a dovish stance. That's why today we saw a surge in Japanese stocks and a noticeable pullback in Japanese bonds. Actually, all of this is related, but there's one thing everyone should pay attention to. The yen didn't move today. This is a big change, and everyone should really observe this. It's actually pretty interesting. Why? Because after Koshi secured a 2/3 lead yesterday, he made a few remarks. I think one of them is quite important. In the short term, he won't touch that. He absolutely won't touch that, and he won't make any moves on that. This means that this person's influence has grown a lot. He said directly that they're keeping close contact with the US. What does that mean? It means he won't make any moves on that. So what he says has become more important. So basically, this is about Japan. It won't let the yen depreciate significantly so easily, because the US doesn't want it to drop sharply. So actually, for anyone investing in Japanese funds, this is a major factor to consider, because that means your fund won't suffer losses due to the depreciation of the yen. So the ideal scenario in the end is that the Japanese government tries every possible way to implement fiscal easing while keeping monetary policy stable. As for the Japanese stock market, this will create a very strong upward momentum, a driving force for the market to rise. At the same time, they probably don't want the yen to appreciate significantly either, but they also won't let it depreciate easily. So the tendency is toward a dovish, relatively stable, mildly weak, and fluctuating situation. In this kind of environment, for everyone investing in yen assets, investing in Japanese equity funds is best. It's worth watching. It's likely, as K3 How You said, it won't rely on additional developments. Basically, Gao has said this before, and actually in the press conference after the meeting today, he said the same thing. For example, after the vote ended, he first mentioned that he tends to be more cautious regarding fiscal policy and lowering the sales tax. This is relatively cautious, so to some extent, that's also why the yen didn't depreciate sharply today. In other words, even though Gao Xi sounded pretty aggressive in his previous statements, when it comes to actual implementation, he's still quite cautious. He doesn't dare to take really big steps, especially since the US also doesn't want to see the yen depreciate significantly. On the third day of the lunar calendar, they said they would set up a new National Assembly to discuss and evaluate how to address these related issues in the restaurant industry, as well as matters concerning consumption tax on food. So the question is how exactly to make adjustments in these areas. At the same time, there may also be future policies like cash subsidies or tax credits. In fact, there's a pretty good chance that in the end, this could turn into something like food vouchers or food stamps. Then, as for Kusho Sho, today he directly stated that he is committed to building trust with the financial markets. Actually, this statement has a significant impact on the yen today, because it means he won't easily allow the financial markets to lose confidence in the Japanese government. So, as a result, a very rapid and drastic change in Japanese government bonds is probably not something they want to see, and a sharp depreciation of the yen is also not desirable for them. This is actually quite important. Then he kept mentioning that when it comes to the food consumption tax, he will avoid issuing new bonds, and instead look for other sources, possibly adjusting subsidies, and also mention tax reductions. Actually, it seems to me that the likelihood of tax reductions is higher. The probability that he will go with tax reductions after taxes is relatively high. Also, his emphasis on being responsible is actually very important, because once this statement is made, it really helps stabilize market confidence to a significant degree. As for overall liquidity, well, it will also develop in a more positive direction. Next, there's the food consumption tax, which is a temporary measure lasting about 2 years, roughly 2 years, and everything is still under discussion. As for foreign policy, basically, it's likely that they might amend the Japanese constitution, and this could actually benefit Japanese companies like Mitsubishi Heavy Industries and those defense industry stocks in Japan. This would actually be a pretty strong move, and it would also be positive for global steel and related raw materials, because if Japan amends its pacifist constitution, the corresponding demand here, especially for raw materials, will become extremely strong. So this is definitely a direction everyone should pay special attention to. And once Japan makes a move, South Korea will follow, and if South Korea moves, China will also take action. Basically, the whole of Asia will be set in motion. So, especially for the Asian region, and even in Europe, it's possible that this year the global demand for raw materials will be driven by everyone. It might turn out to be even more optimistic than what the market estimated last year, and the demand could be even stronger. This actually fits exactly with what we talked about at the end of last year. Whether in the morning call or in person, we mentioned that the raw materials market could be a key area to watch this year. That's how it looks right now. Once prices go up and the market pushes directly in this direction, then demand from Japan will naturally emerge. So after talking about that part, let's talk about Japanese bonds. Basically, last year, Japanese investors were mainly buying German bonds, and for the first time, they started buying French and Italian bonds, while their holdings of US treasuries actually declined. With US treasuries declining, Japanese investors have actually already started gradually moving away from US bonds. Besides this, there's actually another group considering buying Japanese government bonds. On January 21st, Sumitomo Mitsui discussed the possibility of doubling their current holdings. Right now, they're buying about 5 trillion yen, so if they double it, that's about 10 trillion yen. They're still planning to buy another 10 trillion. They're expecting that it might break 2.5, and that a reasonable range would be between 2.5 and 3. What does that mean? Building positions between 2.5 and 3? In fact, to put it plainly, Sumitomo Mitsui is planning to fully build their positions when it's between 2.5 and 3. And the scale of the positions they plan to build is in the tens of billions of yen. So basically, Japan's trading companies, Japan's banks, the big banks, are actually already getting ready to buy Japanese government bonds. So for the entire market, this serves as a very strong backstop. Especially for the Japanese bond market and the Japanese stock market, this will act as a pretty solid support. And in addition, Mitsubishi also directly stated that in the long run, they should start rebuilding their positions in Japanese government bonds, because currently Mitsubishi only holds short-term bonds. They've almost completely cleared out their long-term bonds, so basically they're going to rebuild their entire position. So for this part of Japanese government bonds, there will be a long-term buying force, So to some extent, at least Japanese government bonds won't continue to drag everyone down. But looking at it from another angle, if the Japanese are buying their own government bonds, then who will buy overseas bonds? But for US treasuries, this actually means that there might be one less strong buyer. So for holders of US treasuries, especially government bonds, it might not be as secure. In fact, there could be some impact on US government bonds. That means its risk level will go up, it will increase, because essentially the willingness of overseas holders to keep holding will decline. So if you still prefer to invest in US treasuries, personally, I would suggest looking at companies with very stable cash flows in a stable space. It's possible that, in this area, there will ultimately be one less source of buying support, so this is definitely something everyone should pay special attention to. Correspondingly, you can see that the 10-year yield hasn't continued to surge upward. Even with such a dovish stance, it didn't just shoot up in one big red candlestick. And the 30-year yield has even slipped slightly. That's probably because some real buying interest has actually come in. There are indeed some buyers entering the market. And then there's the yen carry trade. On February 4th, it actually hit a new high again, so this part actually provides pretty solid support for global market liquidity. Like I just mentioned, Japanese government bonds remain stable and secure. And the BOJ themselves are also reluctant to let the yen depreciate too much, but at the same time, they still lean toward an easy monetary policy. So actually, when it comes to the yen and Japanese stocks, it's not entirely a bad thing for the global financial markets either. So at the very least, it means that there won't be a significant reversal in carry trades. And as long as there isn't a major reversal in carry trades, we probably won't see a sudden and severe liquidity crunch in the short term. So this is actually something everyone can keep an eye on going forward. But from what we can see right now, this probably won't be the main trend, meaning a sudden and dramatic reversal in yen carry trades is unlikely to happen in the short term. In the short term, it's just not going to happen. So basically, as long as everyone, From this overall perspective, looking at the global markets, including whether it's the Taiwan stock market, Japanese stocks, US stocks, or European stocks, if you look at it from a global point of view, the bias is still toward going long. The global outlook is still more bullish, but the degree of divergence this year will be extremely pronounced. Some markets will be especially strong, while others will be particularly weak. But as long as you tend to invest in the MSCI World Index, or you just directly invest, because some ETFs invest globally, right? They just buy the whole world. Then you don't need to worry, because the global trend is still bullish overall. The global market is still generally bullish, so you really don't need to worry too much about this part. Now, Johnny, if you already have a particular preference for a certain sector or group, then the topics we'll discuss later will be extremely important and something you should pay special attention to. Plus, the yen might not drop much. For companies, at around 160, it usually holds. But the long-term trend of a weakening US dollar might still be a relatively good direction for the long run. Alright, let me show you. This shift to the real economy could be the mainstream in 2026, and this is data since January 2nd. I'm comparing the relative gains here. I'm using SPY, which is basically the S&P 500, and comparing several of the larger sector ETFs with the overall market. Actually, you can see that in the past 6 weeks, there have been 3 sectors that have been especially strong: consumer staples, energy stocks, and materials. Materials, these 3 sectors are particularly strong, and basically they all have a strong industrial characteristic. So this is just for your reference. Alright, as you can see here, for example, over here, communications aren't strong, consumer discretionary isn't strong, financials aren't strong, healthcare isn't strong either, and as for real estate's doing okay here. Then technology isn't strong, tech is even in the negative, still down here. And then utilities, regular utilities are just average, roughly in the middle. Actually, utilities are negative, they're over here. So you can see that the strongest sectors are really just these few: consumer staples, energy, and materials, those related to raw materials. And then industrials are basically scattered over here. Industrials are spread out here. So basically for the whole first 6 weeks of 2026, the strongest sectors are the real economy. What I'm talking about is the real economy. And that's exactly what their latest article and report discuss. What does long Main Street, short Wall Street mean? Going long on Main Street and short on Wall Street sounds a bit dramatic when you put it that way. So that's why this kind of report is pretty attention-grabbing. To put it plainly, it means going long on stocks related to the real economy. And then shorting stocks that are excessively financialized, stocks with too much financial speculation. What does that mean? It means their valuations are too high. Basically, it means the valuations are too high, so you go long on those high-value real economy concept stocks. This is actually a viewpoint that Michael Henry recently talked about. He pointed out that some small and mid-cap industrial demand stocks in the international market will be relatively strong this year, and last year he actually got a couple of things right as well. Last year, he believed that the international markets would outperform the US market, and he was absolutely right. Europe outperformed the US, China outperformed the US, Japan outperformed the US, and South Korea outperformed the US. Even Taiwan outperformed the US. And that's not even mentioning Latin America, Colombia, and all sorts of other countries. And in Europe, not just Europe as a whole, but even all the individual sectors outperformed the US. Last year, South Korea's market nearly doubled. South Korea really almost doubled last year, so international stock markets were much stronger than the US stock market. And if you look at it from the perspective of the bigger cycle, when the US dollar starts to weaken over the long term, it tends to be a rate cutting cycle, or at least not a rate hiking cycle. Or in a situation where it's not preparing for a rate hiking cycle, the US stock market itself could indeed be relatively weaker compared to international stock markets. So this completely matches the usual pattern we've seen in the past. So what about right now? It's more of a transitional period for positions, with funds also being overly concentrated. So once a reversal trade happens, a drop is inevitable. This was actually quite similar to what happened last week. If you look at the SPW, you'll notice that, hey, if you look at SPW, or SPW with AI stocks removed, basically in an equal weighted scenario, you'll see that all the other stocks are going up. AI stocks are falling, the big tech giants are dropping. To some extent, this is actually because positions are overly concentrated, which is why the Nasdaq appears relatively weak. Then, on the other hand, capital might completely shift from the crowded trades of high valuation AI stocks over to the real economy, and the real economy might turn out to be even more resilient than expected. And this year, in November, the US will have its presidential election. Trump, he absolutely has to win. For Trump, if he doesn't win this year, he'll be under a lot of pressure going forward, and that pressure could be very intense. He might even face legal troubles. In this situation, he'll definitely try every possible way this year to create the impression that the real economy is doing extremely well to foster that kind of atmosphere. Stocks related to the real economy are indeed likely to perform even more strongly, and all the corresponding strategies and policies, whether it's tax cuts or various types of industrial policies, are more likely to support the real economy. On the other hand, those high valuation assets from last year, like Bitcoin, cryptocurrencies, or those AI stocks with sky-high valuations, might face relatively greater pressure. Capital could potentially flow out of these areas and move into other parts of the stock market, or move into other sectors. So this is just something for everyone to consider. This is the latest perspective out there. In fact, we completely agree with this statement because over the past few months, we've been emphasizing this point ourselves. It's possible that the real demand for industrial goods and raw materials could turn out to be stronger than everyone expects. And then, capital has indeed already been moving in this direction for a while. If I look at the year to date, looking at the S&P 500, and if you break it down into more specific sectors, who has been the strongest so far this year? The energy index, food and staples retailing. Capital goods, food and beverages, raw materials. If you just look at the top 5, have you noticed something? In the end, the only one that has risen more than 10% is household and personal products. None of them made it. All the things everyone was talking about last year, have you noticed this? These things were considered boring, dull, outdated, and totally out of fashion last year. You could say they were already out of the trend. You could really say they're not fancy. If you use industry jargon, they're just not sexy, not attractive enough. Nobody wanted to get involved with this stuff. What's so interesting about it? How is this the future? But this year, the money is flowing in this direction. Since the capital is already moving, and today is February 9th, we still have time. We're definitely not too late. If you haven't made a change in the past, you can start making changes now. Because here, we can basically see that smart money is already moving. Smart money is already heading into this field. So it's necessary for us to follow this direction. Why? Because back in January, when I was in Monaco, I also talked with everyone about a piece of news. So tonight, I want to share it with all of you as well. This year, many hedge funds have basically changed a rule. They've made a major structural transformation in how they manage risk. For example, if you had 1 million in capital before, you could only go long with that 1 million, and that was it. If you wanted to increase your position, you couldn't. But now what can you do? Now you can go long up to 1.3 million, but you have to short 300,000, so your total net position remains 1 million. What does this mean? It means that momentum trading here could still be about going long on the strong and short in the weak. Long-short strategies are now being used in this kind of trading. So now, when they're already long here, they'll go even longer, and when they're short here, they'll short even more. Under the old rules, they might have just reduced their positions. They wouldn't have gone short, just cut back. But starting this year, you'll see them increasing their long positions even more. And now, instead of just reducing positions on the weak ones, they might even go short. In fact, they could sell even more, taking on extra short positions. So this year, the divergence could become even more pronounced. The stocks that were already strong may get even stronger, and the ones that were weak may become even weaker. So who are the strong ones now? Over the past year, and especially these last 6 weeks, year to date, the strong ones have all been those traditional industries. And who are the weak ones? The weak ones are the software companies. The weak ones are these software firms. And also the business and professional services. Basically those sectors. The ones related to AI are the weak ones. Month to date, the weak ones are the same. Human services, media, retail sales, yeah, the weak ones are still these sectors. Basically anything related to AI or software, tech in general. Honestly, it's just the nuts. If you look at the components of the NASDAQ, those might be especially weak this year. So who might be especially strong this year? It could be the RTY, the Russell 2000, maybe the S&P 500, maybe the Dow Jones 30. These might be the strong ones. So as you can see on the chart, it's the same. Banks, capital goods, and then these tech hardware and equipment sectors. This industrial characteristic, so basically, the stronger the industrial and production attributes of a stock this year, the better its performance is likely to be compared to others. So if you still really want to invest in AI this year, my suggestion is, if you're going long on AI, please focus on those with stronger production and industrial attributes. If its own attributes have nothing to do with industrial attributes, then it won't be a favored direction for capital this year. This is just for your reference. Basically, this year it has to be connected to the real economy, in plain terms, to production. If it's not related to production at all, then it probably won't be a particularly favored direction for capital this year. Alright, then let's look at each ETF one by one. Starting tomorrow, we'll begin to talk about which sectors and which individual stocks inside them might be worth paying special attention to. But first, let's take a look at the big categories. For example, let's look at this one: consumer staples, energy, and selected materials. In the past 20 or so years, over the past couple of decades, in which years did they also start the year this strong? Let's take a look. The last time SLP had such a strong start to the year was in 2019. Back then, it basically went from about $53 to $62, so it rose by around $9, which is almost a 20% increase, nearly 20%. The last time it had such a strong start to the year, where both January and February were really strong, was in 2019, so I use that as a benchmark. Is it possible that this could happen again this year? This is just for your reference, because it's possible. This is definitely possible because it already broke the annual moving average this year. Similarly, it broke through, pulled back, and held before pushing up again. Now it's above that average once more, potentially starting a bullish trend. Yeah, according to the moving average theory, this area is about to turn into a bullish alignment, with the moving averages lining up in a bullish pattern. So if anyone wants to get in here, my suggestion is to watch for a small pullback. If there's a little dip here, that could be a good entry point. Of course, everyone has their own way of building a position, and each person's logic for entering is different, but here's a suggestion for you all. I think maybe this year. Consumer staples are this year's stronger sectors. Alright, let's take a look at energy, XLE. The last time it was this strong was 3 times, in 2005, 2019, and 2022. So far this January, it's up another 14%. And in February so far, it's up 4.3%. The last time it had such a strong rally was in those years. In 2005, it was February that saw the bigger increase, but in 2019 and 2022, most of the gains happened in January. Alright, in 2005, it was above the yearly average. So as you can see, it basically went from around $18 up to $25, a $7 increase, which is even more impressive, a jump of nearly 48%. In 2019, it underperformed the yearly average, but in 2022, it topped the average, rising from $30 to $43, a nearly 48% gain. So what about this year? Above the yearly average, after completely breaking through the yearly average last year and holding steady, it just kept pushing upward, so there was no hesitation. This year, oil and gas stocks, energy sector stocks might be a very strong group. I think this is something everyone should pay special attention to. Everyone's probably heard a lot of news. This year there's oversupply, demand is still really lacking, and supply is still excessive. All sorts of energy-related horror stories are flying around everywhere. But if you do not speak, the candlestick chart will. Right now, it really does look like this sector could be strong this year. It might even be a very strong sector. So here is my personal suggestion. For your 2026 US stock portfolio, you cannot afford to have 0 oil and gas stocks. You can't have 0 gaming stocks either, so this is basically my short-term view for everyone. As for which gaming stocks to watch, in the next few days we'll talk with you one by one about which groups within this sector are actually worth paying attention to. As for raw materials, XLB has shown strong performance 4 times in the past, in 2007, 2012, 2017, and 2019. If I were to draw a comparison, I think 2017 and 2019 are the 2 years that are most relevant. In 2012, February dipped slightly, but overall performance stayed good. January's performance is usually solid. This year it hit 8.64, and so far in February it's 4.5. Early year performance remains strong. In 2007, it stayed above the annual average, rising nearly 20%. Then in 2012, it was relatively weaker, just a bit weaker. It was only about 10%, just a little over 10%. You can see that in 2012, that year, its performance in February was not as good. So actually, February is a pretty important key indicator. But there's one thing to pay attention to. Please look at the arrangement. Let me show you the arrangement. In 2007, it was really beautiful, a perfect bullish moving average alignment. In 2012, overall, the bullish moving averages actually didn't line up at all, not at all. As for February, it was still relatively weak. Its 200-day moving average was also trending downward, so there was not a bullish alignment. In 2017, the bullish alignment happened right away, so it went from 26 to 30, which is almost a 20% increase, almost 20%. What about 2019? Well, 2019 was quite unique. In 2019, it basically didn't care about whether there was a bullish alignment or not. It just pushed straight up, just kept pushing upward. And what about the most recent situation? The latest data already shows a bullish alignment, so is it possible? If you use the same logic and the same concept to filter, could it happen? Actually, this year, SLB has already confirmed a bullish alignment, and right from the start of the year, it's been relatively strong. Yunmo, but this year it's the same for 2026 XLB. The sectors related to raw materials are also a relatively strong direction this year, so this is just for your reference, for 2026 this year, because we're about to enter the Lunar New Year. So this is just for your reference, since it's already been 6 weeks, which is a pretty clear trend and can serve as a reference for everyone. In 2026, consumer staples, energy, finance, and materials might be particularly strong sectors in the U.S. stock market this year. As for which specific sectors we should pay special attention to, we can discuss that later. And this could also apply to European stocks, Japanese stocks, or even Taiwanese stocks. Whatever the market, it's likely that this year will see a similar trend. At this moment, though, there's nothing definitive I can say about it. None of these 3 sectors, except for raw materials, have shown significant movement. We can see that raw material prices have surged, especially gold, silver, and copper. Aside from the big jumps in gold, silver, and copper, the other sectors like energy, consumer staples, and the overall raw materials industry on the corporate side haven't really stood out. There's no good news, yet stock prices keep rising. This is a very important signal. A rally that happens without any real strength or momentum is actually a true rally. It's possible that the positive factors driving this rise will only be discovered later on. So my advice to everyone is, don't wait until the good news comes out before you jump in. If you want to get in, now's the time, because the candlestick chart and the stock price are already reflecting this trend. As for the underlying logic, we've actually already discussed it. It's all about the demand, whether it's the demand coming from Japan or elsewhere. Or it could be potential demand, like the tax cuts in the US, or Trump himself wanting to promote certain economic or election strategies. Or in Europe, whether it's for military industry needs or for their own manufacturing. Or it could be the situation with aircraft carriers, or in China itself, where the real estate market might remain stable, and there's demand for infrastructure along the Yarlung-Tsangpo River, or for robotics, or because this year marks the first year of the 15th five-year plan, a brand new phase of opening up. Or in Japan, for example, during their process of rearmament, or everything I just mentioned is factual. Or it could be the result of several years of severe underinvestment in capital. Everyone is starting to restock, because if you look at the PMI, you'll notice that PMIs around the world are actually starting to turn upward, especially manufacturing PMIs, which are all beginning the rebound. In this situation, is it possible that the industrial sector will become a particularly important focus this year? This is just for your reference, because everything I'm talking about right now is just an early sign, just some initial signals starting to appear, but the real substantial positive developments may still be ahead, and by that time, stock prices might have already surged quite a bit. So consider this as a preliminary perspective for everyone. How you choose to act is up to you, but personally, I strongly recommend it. In your portfolio, you absolutely need to have these 3 types of sectors. You must have them. You really can't just have only AI. You really can't have a portfolio that's purely just AI. Next, let's look at Brembo. It has an inflation-sensitive concept and index. Basically, the stocks related to the inflation theme are also moving. This one is moving too. Hopefully, it will keep trending upward steadily. Just keep moving up. In fact, over the past month or so, this has been the case. It went from about 5,000 to 5,007, so a 14% increase is pretty normal. It's also up 14%. So, in fact, the inflation-themed stocks are moving as well. As for which stocks are considered inflation-themed, you can see them here. Personnel stocks, then this is Caterpillar, industrial stocks, energy stocks, energy stocks. This one is also an energy stock, then energy stocks, then raw material stocks, then chemicals, then energy stocks, then raw material stocks, and I think this one should be chemicals. This one, if I remember correctly, should be chemicals, and then this is industrial stocks and energy stocks. So everyone is talking about it, really, everyone is talking about industrial attributes, but in fact, all of these have already started to go up, even though when I look at all the related news, it doesn't seem to make much sense. Within the companies themselves, many are already becoming more optimistic about the future, and the stock prices are indeed starting to reflect that. So this is something everyone should really keep in mind. There's a chance that this year we'll see a major structural reversal in the market landscape. Stocks that were very weak last year might actually become strong this year, so pay special attention to that. All right, and then when it comes to economic indicators, we look at cardboard boxes. Why do we look at cardboard boxes? Because they correspond to consumer demand, especially for packages, that is, demand related to parcels. This is Nine Dragons Paper, a state-owned paper company. It's starting to reverse, and once it fully reverses upward, you can see here it actually breaks below and then flips back up. This is even more dramatic. PKG, the American packaging company, has even started hitting new short-term highs, and its moving averages are showing a bullish alignment. So looking at it from the perspective of the cardboard box industry, it's strange. Why are they all surging? But have we seen any clear trends in retail sales or consumer demand that would indicate a significant increase? We haven't seen that. There's been absolutely no related news, yet the corresponding stock prices are reacting. Then I went to check the news, and honestly, I have to say I didn't find anything substantial. Then I went to check the prices for cardboard boxes, and even the prices for paper and paperboard haven't gone up. So from a pricing standpoint, you really can't find any reason for what they're talking about. As for this IP, maybe what they're talking about is things like mergers, restructuring, or capital injections. They're making some operational adjustments within the company, so that's why it's gone up. But PKG, actually, it's just that. They're simply saying their future outlook will be good. And then maybe they're not pessimistic about their future demand. They're talking along those lines. But in terms of fundamentals, we haven't seen anything concrete, yet the stock price is still reacting. Is it possible that, behind all this, consumer demand really will rebound? Is it possible that in the end, what's really behind this is that the overall economic performance could actually turn out stronger than expected? So this year, it's possible that Main Street will start to thrive, while the highly financialized Wall Street could actually be relatively weaker. What we mean by the highly financialized Wall Street is just those stocks with overly high valuations, while Main Street refers to value stocks. Stocks with high value are those tied to the real economy, and they might be relatively strong this year. So this is just for your reference. If we relate this to the Magnificent Seven, you can basically think about which ones are closely connected to the real economy. There are really just a few of them. Among the Magnificent Seven, it's basically Apple. Apple is considered a strong consumer stock, and then Amazon. So last week, Amazon dropped more sharply because it spent too much money. If Amazon's e-shopping segment, its e-commerce, can show a clear rebound, that would be a growth driver that exceeds expectations. And then, as you can see, Target represents department stores and Walmart. Everything is hitting all-time highs. This really reflects consumer spending. It's true, maybe it's a K-shaped recovery, but consumption hasn't actually disappeared. Consumer spending is still maintaining a very strong growth trend. All right, now let's take a look at Europe. Okay, the euro continues to rise and remain strong and volatile, and as for European stocks, they've basically been hitting new short-term highs. It's likely that capital will start flowing in this direction. AI stocks are related to manufacturing. Here, my suggestion's not to focus solely on service-oriented companies. Honestly, I think you should look toward manufacturing. Just focus on manufacturing. So focus on manufacturing, and actually take TSMC as an example. Among AI stocks, TSMC is the one most directly involved in production. It's really all about manufacturing AI-related products. It's the real deal, with actual factories producing real products. It's directly related to manufacturing. So when you look at AI concept stocks, see who is genuinely producing real products, not just acting as a middleman, developer, or simply a consumer. So that's the direction you should focus on. So just look in that direction, and actually the biggest player is TSMC. It's the biggest one. So in the end, when it comes to AI, you might just end up coming back to, well, just buying TSMC. It's possible that ultimately, when you narrow it down, that's the direction you'll end up going. So when it comes to the US stock market, basically it's about things made in America, local packaging and testing, and then some local products, or the demand related to building factories locally, or even the demand for building power plants. Or maybe some US-based companies related to chips, like Teradyne. Teradyne actually also went up after earnings, but it's mainly tied to the AI concept. The company itself produces related products, so it's possible that things will move in this direction. So what are the possible options? We'll have a chance to discuss this with everyone later, but I think we can first talk about some suggested directions, maybe point out a few stocks worth looking into. Oh, as for toilet paper, when it comes to Taiwan stocks, I have to say I probably won't go into too much detail here. But for Taiwan stocks, my personal suggestion is to focus on the big companies with the strongest production capabilities. That might be a better way to approach cyclical stocks. If you want to invest in cyclical stocks, you should head in that direction, focus on that area. So which stocks are we actually talking about? Well, since this is a late night show, I feel a bit awkward naming them here. Maybe next time in Monaco we can talk more about it and discuss with everyone. Alright, so who's looking strong in pre-market? For example, Apollo's considered strong. Oracle is rebounding after a drop, and Robinhood is also bouncing back after a decline. Plus, they're about to release their earnings report, and it looks like the results should be pretty good. MST is weaker as Bitcoin drops, while the US market holds steady. Micron will likely maintain high growth at these levels. Alright, now let's take a look at the US dollar index. No surprises there. The dollar index should continue to weaken over the long term. So, with the dollar index set for a long-term downtrend, international stock markets will generally perform relatively well. Alright, the 10-year is basically in a choppy sideways trend, but I think it's slowly trending upward. I don't think it's going to surge and break above 4.54 points or anything like that, but the probability of it consolidating at these relatively high levels seems pretty high to me. Okay, let's take a look at the Dow Jones. As for the Dow, in terms of index futures, it actually hit new highs during intraday trading. Actually, the Dow really does tend to trend for a longer period. Anyway, the S&P 500 should be the next one to hit a new high, and the one least likely to break new highs is the Nasdaq. I think the chances of the Nasdaq hitting a new high are relatively low. It's possible that the Dow and S&P will go first, and then maybe the Nasdaq will be ready to follow and hit a new high as well. This is quite likely. So if you trade indices, I recommend the Dow. I'd suggest a Dow Jones ETF as a reference, since it's possible this year. All the indices could end up completely diverging, meaning the ones that were strong in the past may no longer be strong this year, and those that were weak before might actually become strong this year. So this is just something for everyone to keep in mind. As for the US stock market, looking back at this past week, who's actually strong? In the next few days, we'll be sharing more related insights with everyone. Hopefully this will be helpful to you when the time comes. So just keep this in mind today, and take a moment to review your own holdings. Think about which ones you might need to swap out. Replace the weak with the strong. How exactly should you go about making your allocations? That's something everyone can think about moving forward. That wraps up tonight's group discussion. Thank you all for listening, and I wish you smooth training. See you tomorrow. Bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.